Hello, what's up, dear audience? Today we are going to discuss a special topic of finance accounting. It is budget and master budget. It's a very vital thing because we can say it is the lifeline of a company. Because if a company don't prepare a budget properly, actually it doesn't know where it will go. So budget is important, but it is unpleasant for a few and pleasant for a few. The bottom line is every company, if he has to survive, he has to prepare a budget, master budget. Today we will discuss a lot about master budget and not in a session. It's possible to cover all steps. We will take a few sessions. We expect you will stay with me, Maruf Ahmed. Hopefully, I will be trying my level best to give you a good insight about budget and budgeting, how to do this. But before this one, we need to understand actually what is budget actually. If you go through the budget, what we know, budget is something which include all costs, all expenses, or it's a comprehensive plan of our operational plan, of our financial plan, of our cash budget plan. Okay, actually, what happens in a master budget? It is prepared for a period. It might be 3 months, it will be 6 months, it will be a semester or for a year. And budget include sales, production expenses, cash flow, and financial statement. The majority of the budget cover actually 9 steps. First, sales budget. Second, production budget. Third, direct materials budget. Direct labor budget. Step five, manufacturing overhead budget. Selling and administrative expense budget. Cash budget. Budgeted income statement, and budgeted balance sheet. It seems that it is a little cumbersome. 9 steps, how it's tough, or how we will prepare. But it will be very easy. Please stay with me. I will take you to the step-by-step process how it is prepared actually. Let's go to the master budget. In our lesson 1, it's a master budget. We'll detail it for you. Just stay in touch with us. Okay. What we told earlier, actually, first of all, is the sales budget. A company plans how many units it is going to produce for the next year, or sorry, how many units the company going to sell. Its expectation is the plan. Expected sales unit are here. If we go to sales budget, suppose we will prepare for a 3 month budget. You can see from here it is month January, February, and March. The units we want to sell in these 3 months. In January, 1000 unit, in February 1200 unit, and in March 1500 unit. Total in Q1 we want to sell 3700 unit. Okay. If we assume that our per unit price we have charged 50 US dollar, so if we multiply 1000 into 50, uh, it result 50,000 US dollar. And in February month, if we sell 1200 unit, then uh, we know that our average price is already $50, we assume. So total sales revenue will result 60,000 US dollar. And in March, we want to sell 1500 unit. Our average selling price is 50 US dollar. It will stand 75,000 US dollar. So in Q1 we plan we will sell total 3,700 units, and our sales revenue will stand 185K US dollar. Okay, fine. And whether the figure is okay or not okay, we might multiply and check whether we are okay or not. I multiplied for your simplicity and clear understanding, and hopefully the result is the same. Okay, check it. Okay, same. Thank you. Now we will go to the production budget. What is production budget? Actually, production budget indicates how many units we have to produce. We had a sales plan earlier. We are on a sell 3,700 units. But how many units we have already and how many units we need to produce, we need to decide it. It has a formula. It has a formula. Actually, required production is equal to sales plus desired ending inventory. How many units we want to hold after sales or after the Q1. It means desired ending inventory. And what was the inventory at the beginning minus beginning inventory? It indicates the this figure we have to produce for the next three upcoming months or for Q1. Okay, okay. Then go to the row wise month sales status, desired ending inventory, beginning inventory, production units. Month January, February, March, total Q1. We wanna sell 1,000, 1,200 and 1,500, 3,700. We want after sales Q1 at the end of January we will have 300 units in hand on hand. After February we will have 400 units on hand, and after March we will have 500 units on hand. Total Q1 1,200 units on hand. I'm gonna hold. We had a beginning inventory in January. We had a opening inventory 200. In February we had opening inventory 300. And in March we had opening inventory 400. Okay, so at the year at the Q1 end, our what we can see inventory 900 almost. That is not our target. Our basic target is to how much units we have to produce. This one. Okay, okay. Then what we have to do. So how many units we have to produce? We have already known a formula. Required production is equal to sales plus desired inventory minus beginning inventory. Let's calculate. These are our expected sales unit. Our opening inventory was 300 and beginning inventory was 200. So it was 1100. See it match, it match. So what we want to produce, it match. Hopefully your production budget is also clear. How a company prepares its production budget. Okay. Now we will go to the direct materials budget because when you plan to production, then you need materials, right? In the raw materials, okay, and other stuff. Now we will go through what is direct materials budget. We assume that every unit we want to produce or sell, we need 2 kg of materials, which will cost at the rate of $5 per kg. Okay, if this is so, then what happens? What will the cost we will incur in January, February, and March? Okay, in January we plan to produce 1100 units and materials per unit we need 2 kg per unit. So total materials required 1100 into 2 is equal to 2200 units. Sorry, 2200 kg actually. This kg is required. Okay, and cost per kg was $5. So we have to total incur 11K. Okay, in the February, in the same calculation, we have to incur 13,000K. And in March, we have to incur 16,000K. Okay, in total material cost we have to spend for materials 40,000. Okay, hopefully you have no doubt because the units will produce the same. Okay, almost same. The production unit same, the production unit same matches, and for every unit of production, we need 2 kg of materials. Okay, and then what is the total materials required? We can see this one multiply into this one. Okay, This one multiply, it is to 220 kg and cost per kg is 5. So what happens? Now we have to multiply into 5. This is 11,000. It matches. Okay, it matches. Hopefully you find it already match. No problem. It match. It match. Okay. So every other parts will also match. There is no doubt. There is no doubt. Okay, 40,000, 40,000. Then we can understand or figure out uh, what will be our materials budget actually, or how many materials we need to produce 4,000 units, or how many costs we might incur in the future, uh, in future to produce our product actually for Q1. A business owner, business manager, CWO has to prepare for this. Uh, this fund has to be available. This fund has to be available in the treasury for the materials purpose. Okay. Now we'll go direct labor budget. What is labor budget? You know, definitely I or you will not produce. It will produce by the labor. Okay, or factory people. So we also have to understand how much we have to pay to produce those units. We have to pay to the our laborers or factory people. Direct labor budget. Calculate labor cost of production. Assume each unit require 1.5 hours at the rate of $10 per hour. It indicates if you want to produce every unit, then what will happen? We require 1.5 hours, and for every hour we have to pay $10 to the laborer or the factory people. Okay, then as we will produce the following, how much labor cost or factory cost we have to factory labor people, especially factory, how much we will have to pay actually. Okay, it's a row line. You can see month production unit labor hours per unit, total labor hours cost per unit, total labor cost. In January, February, March, it are the units we want to produce, labor hour per unit 1.5. So total labor hours required 1650 because 1 on double zero, this one into this one 1650. You see? Okay. It indicates we need total 1650. We need total 1650 hour. Okay, 50 hour to produce and cost per hour $10. Okay, the total labor cost we will incur. Total labor cost we will incur. Okay, let's check whether we are okay or not. 16,500. Okay, it matches. It also matches. So we are in the line. Okay, and very aligned. Whatever. Now it matches. Okay, you see matches. So our CFO has to be very prepared that he needs a total 60,000 US dollar for the Q1 as in terms of labor cost to produce the 4,000 unit. Okay. Now we will go to manufacturing overhead budget. What is manufacturing overhead? Actually, if you wanna produce your product, you need a factory. Factory has utility cost. Factory has rent. Factory has and some other costs, license, etc., etc. Maintenance. These are called overhead. That is called manufacturing overhead. We have also need a budget for manufacturing overhead because without factory, how you produce? In the month of January, we want to produce 1,100 unit. We have checked our variable overhead is $3 and fixed overhead is $5,000. What is the difference between variable overhead and fixed overhead? Variable overhead means actually if you want, you can reduce some electricity bill, but if you want, you can reduce the factory salary. factory rent, that is fixed overhead. So those costs are fixed overhead. So we have calculated what is the fixed overhead in our factory. We have found that 15,000 units. It is our fixed overhead. Whether we produce one unit, two unit, three unit, or four unit, we have to pay 15,000 unit. But what we have checked, if we produce 4,000 unit, then our variable overhead will come 3 US dollar. Okay, per unit. Then total overhead is equal to fixed overhead is equal to variable overhead per unit into production unit. Suppose if we produce 1100 unit, so 1100 unit multiply 3 US dollar. Okay, so total it will come 3,300, and we have a fixed overhead 5,000. So we have to incur 8,300 in total in the month of January due to our overhead. Similarly, we have to pay 9,900 in the month of February, and we have to pay 10,800 for the month of March. So total Q1 we have to incur 29K. So our CFO sir has to be very prepared about the manufacturing overhead. Okay. We also have calculated the current variable as well for for 1,100 units. If $3 per unit, what is the current variable overhead? And similarly, you can see. So hopefully, we have a, we have glanced over and we have a little idea about manufacturing overhead actually. Now we'll go to selling and administrative expenses. Actually, after you production, what you do? You sell. Okay, and you need a liaison office to sell your product. You need a license. You need an office building. Okay. Not only this one, you need some salaried employees which are not directly related to production or factory. Okay, whether you produce or not, you have to keep them. So you have to incur some expenses. That is called selling and administrative expense. Even we have to pay some incentives and commission to our salespeople because it motivates them very much. So we also need a budget for them also. Hopefully you understand now. It is basically actually administrative type of expenses. Okay, salespeople dress code, your ID card, your electricity, your AC bill, your AC, everything will cover into selling and administrative expense budget. Okay. So we have calculated in January, February, and March our variable expense. We have assumed that it is almost 2%. Okay, almost 2% of sales. So as we plan to sell, hopefully you can recall this one. Okay, so our calculated variable expense is 1,000 US dollar. In February it is 1,200 US dollar. In March it is 1,500 US dollar. So total income 3,700 US dollar. And our fixed expenses, earlier we told salary it is a very fixed expense, rent is a very fixed expense, license cost is a very fixed expense. Okay, so we have to incur the following expenses as well. So total expense is equal to variable expense plus fixed expense is equal to sales and administrative expense. For your easy understanding, we may check the formula. It's okay or not. It's okay. Okay, it matches. It match. So now we are here for selling and administrative expenses. It match, and we are clear of selling and administrative expenses. Now we'll go to the cash budget. What is cash? Cash budget means cash flow. When we sell, we receive inflow, and when we buy, actually we send outflow. When cash in, it is cash inflow. When you cash out, it is cash outflow. Okay. Organization has to be very careful of its cash budget as well because without cash, how do you prepare for the next period where money will come for production, where money will come for labor, where money will come for manufacturing, where money will come for manufacturing, sales and administrative. So cash budget is a very vital thing. Okay. We all have to be very careful. Okay, cash budget. If you through cash budget, some terms might be very, what can I say? Some terms are very popular, and some terms we are also aware. Okay. Suppose inflow, what we see cash sale, collection from credit sale, collection from other sources like vendor, government, or partner. And outflow, what we understand, payment for materials, labor, overhead, sales and administrative expenses. They are called outflow. Okay, in the month of January, February, March, Q1, beginning cash were 10,000, 24,200, 41,600, total 61,300. We have received we have received cash inflow, the cash in our company, 50,000, 60,000, 75,000, total 1,85,000. Okay, and the cash out of our company, 35,800, 42,600, 55,300. Total cash out from the company, 1,33,700. Okay. Now, what was our ending cash? Okay, it was our net cash. What we can say net cash. In the January, we had net cash 24,200. Okay, and in February, we had a net cash of 41,600. In March, we had a net cash of 61,300. How it comes? Okay, we know our beginning cash, the cash inflow minus the cash outflow. Okay, you see, so 24,200, or it matches as well. It matches as well. So, what happens? How many income we have on hand? And so, how many net cash we have on hand? We have 127,000 on it. Okay, it matches. It also matches. Okay, hopefully, we can understand a little more from this one. Now, we'll go budgeted income statement. Budgeted income statement. What does it mean? Actually, we have planned to sell, we have produced, we have incurred labor cost, material cost, manufacturing overhead, sales and administrative expense. We have also cash. But actually, how much we income from the sales, net income. It's the prime concern. You may sell a lot, but you couldn't earn anything. Then why we need a lot of arrangement if we can sell and can earn even a penny? So it is very important. We also need a good position and planning that definitely how much return the business will generate. We can say it is also say it is ROI, okay, as well to some owners. Actually, our business owners, our CWO are very interested about positive income statement. Okay, okay. Let's check in January, February, March. So, no, we plan to sell 50,000, 60,000, 75,000 total 1,85,000 we want to sell in Q1. The cost we have to incur due to production, COGS, cost of goods sold. You understand hopefully cost of goods sold. If you don't understand, definitely we'll detail in some other lessons. It is due to production. The production cost we incur due to the production. We can just for a little understanding the raw materials cost. Okay, it will also go to the cost. The direct labor cost it will go to the cost. Direct manufacturing cost it will go to the cost. Okay. Uh, in altogether it ends up with COX, okay, per unit COX, whatever. To produce 50,000, we have to incur cost 35,800. Gross profit, this one minus this one is equal to this one, okay. So gross profit is 14,200 and selling and administrative expense is minus, uh, selling and administrative expense is 5,000. So if you minus 14,200 minus 5,000 is equal to 9,200. It is on net income. After all sales activities, all cost deducted, this amount will be on our hand. Amount will be on our hand, which will give us some pleasure. Okay. In February, We have net income 12,200. In March, we have 14,200. Total Q1 overall net income is 35,600. Okay. This is our total net income, budgeted income statement. Actually, whenever we plan a budget, a business owner, a COO, a CFO wants to know after all of the workings, after all of our efforts, what is the remaining US dollar, what is the remaining dollar we will have for us for the next year or for the next period of time. Now we'll go to the budgeted balance sheet. Every finance graduate, every accounting graduate, every bookkeepers, everybody knows what is balance sheet, asset, liabilities, owners, equity. Okay, so I think it hardly needs any detailing. That is, as we are working on master budget. Still, for your simplicity, budgeted balance sheet indicates to do the above business on net income. We have to incur some asset, liabilities as well as equity at the end of the period. Okay. Well, we have some cash, we have some inventory, and we had some account receivable and payable from previous budgeted. Okay, what are those? Actually, there are things. Hopefully, you understand. They are not need to be detailed, but these are the all points. I think hopefully you can understand. I've covered in lesson 1. There are 9 steps, actually total 9 steps in the master budget. If you can prepare them all, if you can understand them all, it only indicates you are a something genius. You can produce a budget. A good budget indicates a good CFO. So if you can prepare a good budget for the company, definitely you will be in top listed employee of any organization. Some key points for you: master budget. We know actually it is all functional budget combined, and it starts with sales budget and it drives production, labor, and cash requirement. Breakdown by month or quarter for accuracy, and include cash, income, and balance sheet position for decision making. It helps in decision making very much because budget is the only thing which will give you profit before actual profit. It is projected profit, and the pleasure it will give. There is nothing similar to it because nothing will give you so much enjoyment, so much pleasure. Actually, every owners, every CWO, they are very bother of budget. Okay, they are very bother of their projected income. So hopefully you understand. We have already detailed. Please put your comments in our channel. We have already covered one part of our master budget, and in some other lessons, definitely we'll go through some more budget also, which will simplify your understanding much more. Our plan is to just to put the budget in your head in such a way so that you don't have to be confused or frustrated in next time what is budget it is. Now understanding what is budget it is. So thank you very much for this time. Please stay tuned. Hopefully we'll give you some good offerings, some good gifts in the time ahead, but we need some time. There might be some limitations in our presentation. You will take it with your pardon. Something outstanding, something splendid is waiting for you in next lesson as well. For the next lesson, thank you very much. Thank you.